Assalamu alaikum. Welcome to question 51 of ATX revision kit. This question is from your multi-tax personal including overseas. This is a 25 marks question which comes in your section B of your ATX exam. So let us do this. Let us go to the requirements first, like we always do. So the first requirement, you have to explain with some calculations the capital loss which arise on the sale of some shares to Nathi and how this loss can be relieved. Okay, so the first you have to calculate the capital loss and how that loss will be relieved is the next part, 4 marks. Next, advice on the availability and the effect of installment option for the payment of inheritance tax in respect of each of the investment property and antique shares on the assumption that Caden dies on 20 March 2029. No calculations are required for the second part of A. You always have to advise. 3 marks. B. You have to calculate Caden's taxable income for the tax year 24-25 on the basis of IR 35 applies to the budgeted fee income receivable by Mandini Limited in the year ended 31st March 2025 for 5 marks. So this section you have to be prepared for this. Even personal service company might come. Okay. Then C. For the tax year 24-25, advise Amahle why the interest receivable in respect of a bank account in the country of Comor will be subject to UK income tax. And explain with supporting calculations why this will not actually result in any UK tax payable. 8 marks. You have 2 requirements to do here. So here, first we'll go through this. So here, Caden is a resident and domicile in UK, sole shareholder, director and employee of this company, and Amahle is Caden's wife who receives interest income in respect of bank deposit in the country of Comor. So now you have acquired some antique chair. Okay, there was 6 antique chair that was gifted by his mother on 3rd March 2022. Chairs had a market value of 150,000, 152. Faber had purchased these chairs for 106 and now they are selling. So they have sold 2 of the chair to an unconnected person for 42. The 4 remaining chair was 93. Now Kara is proposing to sell the 4 remaining chairs to his son Nati for 35. These 4 chairs are expected to be valued at 99. Okay. So the question is, once again we'll read requirement 1. Capital loss regarding selling antique chairs to Nati. So it's a loss because here selling it for 35 but value is for 99. Now, so before we read on the other things which are not so relevant for our requirement A, we can straight away go to requirement A and calculate how the loss will be relieved and calculate the loss. So the loss market value of the 4 chair is 99,000, but the cost there is a working to it. Okay, why? This is a transaction done to a connected person. Caden's son is a connected person to Caden. Because of that, the market value of the chair on this date will be used as proceed. We have done that already, 99,000. Capital loss will be calculated. Okay, so this really, because this is to a connected person, same like question 45, this loss can only be relieved against any gain from the same person. That means to the son. Any gains that you have got from the son by selling to the son, you can get this loss relief against that only in this tax year or future tax years. So now let us go to the working and do that. So the market value of the 6 chair is 152. This is a part disposal. That's why we are doing this fraction. Out of the 6, how much you have sold? Okay. So the first 2 chairs. You see, you have sold 242 and remaining 4 is for 93. So disposal of the first 2 chair. This is for remaining 4. So this is the cost of the remaining 4 chairs. Once you have sold the 2, this is 6. This is the cost of selling 2 chairs out of the 6, out of that set. So the cost of remaining 4 chairs is this. They have not given you the cost of remaining 4 chairs. What they have given you is market value of the 4 chairs, that is 99. So the cost of the 4 chair you have to find out like this, because it's a part disposal. So this 104 you will use here, and this is your allowable loss. So you have answered the requirement first part of A. Second, no calculation required, but you have to explain your availability of installment option for inheritance for 2 things: investment property and antique chair. Remember, antique chair is easier. It's not a qualifying asset for installment option. Done. But when it comes to investment property, they are qualifying assets for installment option for payment of IST. When you are studying IST, make sure that you know which ones are qualifying asset for installment option, which ones are not. This will help you. Okay. Provided Nathi still owns that property on this date when it is the date of his father's death. In how many installments will they pay? 10. 10 equal annual installments. IST will be paid. When will it start? 6 months from the date of death. You see, it is before September. So from 20th March, if you take April, May, June, July, August, September, the last month, 30th September 2029. However, if Nathi sells the house within the 10-year installment period, what happens? This is 10 equal annual installments. Annually 10 you have to pay. So if within the 10-year installment period Nathi sells this house, outstanding liability will become payable immediately. You have to pay the whole amount. Okay. So for your tutorial notes, they have given one thing. They are saying installments for IST can only be made on land and buildings, unincorporated business, shares or securities. Where? Because donor has a controlling interest also in this. They can control the land and buildings, their business, their shares. They have a controlling interest there. But antique chairs and all, you don't have a controlling interest. Now, coming to B. So you have to apply IS 35. Remember, for this one, mostly what they are asking is deemed employment payment. And this is a pro forma that I have taken you through that you need to apply here. But we need to read the case study for it. So here, under Mandani. Mandini is a personal service company and it has already been qualified as small. So now, their budgeted fee income is 65,000. Gross monthly salary is 1,500, paid dividend of 35,000. And that's it. With that, you can answer. So you start with budgeted income. This is statutory reduction. You deduct from it. So 65,000, you deduct 5% on 65,000. Then your salary was 1,500, but this is monthly. You have to take annual. That's why you multiply by 12, deduct the salary, and then deduct your employer's NIC. From 18,000, this is your salary. Take 9,100 into 13.8. This is fixed. It's a formula. Whatever is your salary, you deduct 9,100 and into 13.8%. Then Employees NIC on the deemed payment. So on this payment, 13.8 divided by 130. So it's always into 13.8 divided by 113.8. When it is NIC on deemed payment and deduct. Then you get the deemed employee payment. So your total employment income. Remember, to calculate taxable income, you need your total employment income. What is it? Your salary, annual salary, and deemed employment income. This one. And on that personal allowance, you deduct fully because total income is less than 100. Get your taxable income. So that's it. The question asked you once again. Let us read requirement B. They calculate taxable income. So you have calculated the taxable income. Always check back whether you have answered the main requirement or not. Here, why interest receivable will be subject to UK income tax, and explain why it will not result in UK tax payable. Two things in C. So first you have to calculate the interest. Okay, so we'll read part C. So he's also resident domicile in UK, earns employment income of 45,000, personal pension contribution of 3,000 net. You have to gross it up when you expand the basic rate and high rate band. Now he has deposited 150,000. Bank pays 5% interest. This is gross. Will not remit any of the interest income to UK. Taxes withheld at the rate of 18%, and UK does not have a double tax treaty. Okay, so here very important, because he's getting an interest from another country. You have to see whether he's a domicile and resident in UK. You have to talk about it. So here he's a resident in UK. Because he's a resident in UK, she is a resident in UK, she will be assessed UK income tax on her worldwide income. The moment you are resident, no question. Wherever your income is, UK tax will be charged there. Including the interest, you have to write this, including the interest on this country. So here the remittance basis will not apply. It doesn't matter whatever you remitted or not. So the remittance basis is not available to her because she's UK domicile also. She's UK domicile as well as resident. So you don't have to remit. Okay. So whatever the interest you have got, full, she'll be charged. So in the tax year, her basic rate band will be extended by the contribution that she makes. This 3,000 you have to gross it up. How do you gross it up? 3,000 into 100 divided by 80, because when you are netting it, it's at 20% basic rate. That's why divide by 80. So the amount will be 3750. It will be more than the net, obviously. This is the gross figure. This you add with the basic rate, and this will be your limit now. New basic rate limit. So now, once you get that, calculate your taxable income. So take your employment income and interest income and add them together. What is your interest income? You got 150,000, on that apply 5%. This is 7,500. Employment income is already given as 45,000. So with 45, add 7,500 and deduct personal allowance. And if you see, it falls into her basic rate band. So because it falls into basic rate band and she's having an interest is at savings rate. She's going to get a savings nil rate band at 500. Sorry, at 1,000, because basic rate. So how much will be her UK income tax? 1,000 of savings at 0%. See, her savings income is 7,500. Interest is her savings income only. First 1,000 0%. That is the nil rate band, and remaining 6,500 at 20% because basic rate. So 1,300. Done. First part you have answered. What is the first part of the requirement? You have advised why the interest receivable will be subject to UK income tax, because domicile and resident. Next, with calculations, you have to explain why it will not be charged to UK tax. Second part, now you have to answer. So this is easier. So because see this is an overseas. So you have to talk about DTR, double taxation relief. You have to talk about this. Already income tax, interest income was taxed in Comor. So you are going to get a double tax relief. What is the double tax relief? Lower of the UK tax and overseas tax. What is the overseas tax? So you have got your interest income. First calculate interest income correctly. So your overseas rate, they have given 18%. So take 18% on that 7,500 interest, which is 1,350. And what is the UK tax? Just now you have calculated from here 1,300. Which one is lower? The UK tax. So because UK tax is lower, this is equal to your double taxation relief. That's why you should not pay any tax in UK. Whatever UK tax you are paying, it will get relieved through double tax relief. You understanding 1,300. That's why you are not paying any tax in UK. With this, you have answered question 51, and now I shall see you in the next question from the ATX revision kit. Thank you.